Most investors want stocks that look exciting, high growth, hyped up, and safe. Me, I look for the exact opposite. I buy stocks no one else wants, the ugly ones, the ignored ones, the ones people think are going out of business. And here's the crazy part. That's where the real value usually is. Some of the best investments I've ever made started with a stock everyone else was too afraid to touch. In this video, I'll show you exactly why I go where others won't, and how that mindset can change the way you invest forever. Most people want to feel good about the stocks they buy. They want a story, a brand they recognize, a chart that's going up, something that feels safe and maybe even a little exciting. And I get it. I used to think the same way, but here's the problem. When everyone's comfortable, when a stock feels safe, it usually means you're paying full price. Or worse, you're buying into hype. That's why the best opportunities are usually the ones that feel uncomfortable. They look messy. The financials are rough. The stock is down 80%. People call it dead money, and that's exactly when I start paying attention. Most investors, especially new ones, have a natural bias toward good-looking businesses. They want to own stocks their friends have heard of. They want clean balance sheets, strong earnings, exciting growth, and buzz. They want to feel like they're investing in the next big thing. So when they come across a small, ugly company trading at 50% of book value with no growth, no hype, and zero media attention, they skip right past it. They think, there's got to be something wrong with this. And sometimes they're right. But here's the key. They're making that decision emotionally, not logically. They're reacting to the story, not the price. Let me show you how this plays out. Imagine two stocks. Stock A is a fast-growing tech company with flashy branding and a CEO who's always in the news. The stock is up 200% in the last year. Everyone's talking about it. It feels good to own. Stock B is a small industrial company no one's heard of. Revenues are flat. The website looks like it was built in 2005. The chart is ugly. The stock is trading below the value of its current assets. Almost everyone will choose stock A, not because it's undervalued, but because it feels better. It feels like the right move, even if stock A is wildly overpriced. And that's the trap. Markets are made up of people, and people are emotional. They chase comfort. They run from fear. And that means ugly, boring, or misunderstood stocks get ignored for too long. That's exactly what Benjamin Graham, Buffett's mentor, understood. He used to say, the investor's chief problem, and even his worst enemy, is likely to be himself. That's never been more true than today. We're in a world where everything is driven by headlines, hype, and social proof. If it's not trending, no one cares. If it's not growing 50% a year, it gets dumped. And if the business looks like it's in decline, even temporarily, investors abandon it. But guess what? That creates opportunity. Because when everyone else is running away, prices drop below reason. Stocks trade for less than their assets, sometimes for less than cash. And that's where deep value investors step in. Not because we're fearless, not because we're reckless, but because we've trained ourselves to look past the surface. We look at the numbers. We focus on price versus value, and we accept that sometimes the best investments start with discomfort. In the next part, I'll show you exactly what I look for in these ugly stocks, the basic checklist I use to decide whether something is cheap or just garbage. Because not all ugly stocks are value plays. Some are just bad businesses. The skill is knowing the difference. So now you might be wondering, if these stocks look so bad on the surface, if they're ignored, beaten down, and often in declining industries, why would anyone want to own them? Why would someone actually go looking for the ugliest stocks in the market? Because deep value investors, people like Benjamin Graham, Walter Schloss, Seth Klarman, even early Buffett, don't invest based on appearance. They invest based on price versus value. Here's the core idea. If you can buy something for far less than it's worth and the downside is limited, you don't need a great business. You just need a good deal. It's like walking into a pawn shop and seeing a Rolex in the corner selling for $800. Maybe it's scratched, maybe the box is missing, but if you know the real market value is $5,000, you buy it. Not because you love pawn shops, but because the numbers make sense. That's what deep value investing is. It's about buying stocks so cheap the market doesn't need to love them for you to make money. They just need to go from terrible to mediocre, and that alone can trigger a 50%, 100%, or even 200% return. Here's the thing, most investors look for great companies. They want strong brands, competitive advantages, and high return on equity. And that's fine. When those businesses are undervalued, But most of the time they're not. They're expensive, fully priced, sometimes overpriced by a lot. Deep value investors flip the script. We don't care how boring the business is, how bad the headlines are, or whether Wall Street analysts even cover it. We just ask, is the price irrationally low? Are the assets real? Is the downside limited or even protected? If the answer is yes, it's worth a closer look. This is especially powerful in small cap and micro cap stocks. Why? Because big investors, hedge funds, institutions, and even ETFs can't buy them. They're too small, too illiquid. It's not worth the effort for someone managing $10 billion to dig through a $20 million company trading at 50% of liquidation value. But for private investors like us, that's where the edge is. We can go places the big money can't. We can buy when everyone else is ignoring it. We can hold while the price recovers, even if it takes a year or two, and realize value that others simply missed. Here's another reason deep value works: reversion to the mean. In markets, things tend to swing too far, both up and down. Fear pushes prices below fair value, and greed pushes them way above. When a company is out of favor, the market overreacts. It prices in permanent decline. It assumes no recovery. But businesses are messy. Some bounce back, some shrink but survive, some get bought out. And when you're buying at 30%, 40%, or 50% of book value, you don't need a miracle. You just need reality to be slightly less bad than expected. And the best part, you don't need to be right every time. Deep value portfolios work because the math is on your side. If you buy a basket of 10 to 20 undervalued, asset-rich, and unloved companies, some will stay flat, some might go to zero, but a few will double, triple, or more. Those winners carry the whole strategy. It's not about hitting home runs, it's about stacking the odds in your favor over and over again. That's why I go hunting for these ugly stocks. Because when the market is emotional, logic gives you an edge. In the next part, I'll show you my personal checklist, what I look for when evaluating these kinds of opportunities. Not all cheap stocks are good ones, so you need rules. Let's go over them. So what exactly do I look for when I'm digging into one of these ugly stocks? Not every beaten down company is worth your money. Some are just junk, some are cheap for a reason, and sometimes a low price is just a trap, not an opportunity. That's why I use a simple, repeatable checklist before I get serious about any stock. It's not perfect, it doesn't guarantee success, but it helps me avoid the most common value traps and focus only on companies that have real deep value hidden under the surface. Let me break it down for you. The most important rule: it must be trading below net current asset value. This is the cornerstone. If a company's stock is trading for less than its current assets minus all liabilities, I'm interested. That means I could, in theory, shut down the company, sell off the assets, pay off all debts, and still walk away with more than I paid. I like to see the stock trading at 60 to 70% of net current asset value or less. That gives me a margin of safety. So even if things get worse, I'm not overpaying. You can calculate net current asset value pretty easily. Take current assets like cash, receivables, and inventory, and subtract total liabilities. Then divide that by the number of shares. If the stock price is way below that value, you've got something interesting. Second, strong cash position or low burn rate. Cash is king, especially when you're investing in struggling or ignored businesses. I prefer companies that have a lot of cash relative to their market cap, or at least a low burn rate, meaning they're not losing tons of money quarter after quarter. Even better if the company could survive a couple of bad years without raising capital or going bankrupt. I don't want to see debt ballooning or expensive financing deals just to keep the lights on. Third, low or no debt. If I'm investing in a weak or struggling company, I don't want them buried in debt. Why? Because debt holders get paid before shareholders, especially in a liquidation. So even if the company has decent assets, a lot of debt can wipe out your margin of safety. I look for a low debt to equity ratio or at least more cash than total debt. If they've been slowly reducing debt over time, that's even better. It shows discipline. Fourth, insider ownership and buybacks. If management owns a meaningful chunk of the business or is buying back shares, that's a strong signal. It shows they believe the stock is undervalued too. I don't want to be the only one who thinks it's cheap. If insiders are buying, it means we're seeing the same thing and they have skin in the game. Fifth, stability, not greatness. I'm not looking for amazing growth or wild innovation. I just want a company that's not dying too fast. If revenues are flat or only declining slowly, That's fine. If the business is breaking even or only losing a little money, that can work too. But I don't want to see collapsing revenue, huge write-offs, or a situation where survival depends on a miracle. This isn't about finding the next Tesla. It's about finding the company that's worth more dead than alive and buying it before the market realizes that. Sixth, it should be tiny and ignored. I don't mind if the stock is illiquid, underfollowed, or has no analyst coverage. In fact, I prefer it. The less attention the company has, the more likely it is to be mispriced. That's where small investors have an edge. We can go where the big players can't. If I search the ticker and barely find anything, that's usually a good sign. That's my core checklist. It's not flashy, it's not complicated, but it's built to help me find those rare, dirt-cheap companies that still have real value behind them. Remember, most of these companies will never appear on a top 10 list or in a hot stock newsletter, but that's exactly why they're interesting. So now you know the truth. I don't look for hype. I don't chase trends. I look for value, real, measurable, and overlooked value. And that means going where most people won't, into stocks that look terrible on the surface, into companies no one's talking about, into places where the market has given up, because that's where deep value lives. That's where real opportunities are hiding right in plain sight. The funny thing is, this way of investing isn't new. Benjamin Graham was writing about it nearly 100 years ago. Buffett used it before he became famous. And even today, with all the algorithms and noise in the markets, it still works. Why? Because human behavior hasn't changed. Fear, impatience, and herd thinking, they're still running the show. And if you're willing to go against that, to buy what no one else wants, to stay patient while others panic, you have an edge. That's the whole idea behind this channel. Not just to throw stock tips at you, but to help you see the market differently, to help you think like a real investor, not a speculator. If you've made it this far, you're not average. Most people click away the second they realize I'm not trying to sell them the next 10x rocket ship. You stuck around because something in this made sense. It resonated. Maybe you've been burned by hype. Maybe you're tired of chasing and ready to learn how to build. Either way, I'm glad you're here. Because this channel is for people like you, smart, patient, independent thinkers, people who want to understand how real wealth is built over time, quietly, methodically, and with discipline. Now, in the next video, I'm going to show you my last big net win, a real investment I made, a company that almost nobody was watching. The financials looked boring, the chart looked awful, but when I dug into the balance sheet, I saw something others didn't, and I acted. I bought it when everyone else ignored it, and what happened next reminded me exactly why I follow this strategy. This isn't some theoretical example from 1954. This is a real-world case study from my own portfolio. And it's the kind of story that'll show you how deep value investing doesn't just work in theory, it still works right now. So if you want to see how all of this applies in the real world, how I actually use this checklist and mindset to find hidden value, make sure you don't miss the next one. Hit subscribe, turn on notifications, and stick with me, because this is just the beginning.